Welcome back to the Property Playbook CLT. My name is Andrea Robson, and today we'll be discussing the difference between home equity loans and HELOC, which is home equity line of credit. I'm here with Jay York from CMG Home Loans. How are you doing, Jay?
I'm good. How are you?
I'm doing very good today.
Good deal.
Not only is Jay part of my family as Phi Beta Sigma Fraternity Incorporated,
Yes.
Who's your favorite football team?
Go Birds.
We have more family.
Absolutely. Celebrating all year.
All year long. People were sick of me all month of February.
Get ready.
Yes.
Just getting started.
Yes. So we have all types of family today. Phi Beta Sigma. Go Birds all day. And I wanted to bring him in today because I know he will be able to inform us the differences between this topic. So let's just go ahead and dive into it.
Sounds good.
So home equity loans versus HELOCs, home equity line of credit. What's the difference between the two?
Yeah, so the biggest difference between the two is going to be the structure of it. So a home equity line of credit is just how it sounds. It's a revolving, basically almost like a credit card in a sense. Not the same,
right? But
similar premise where it's a revolving line. You can use it, pay it down, reuse it in what they call like a draw. So you have a draw period on it. With a home equity loan, it is literally like a lump sum, one time that you get, and then you pay it back on a fixed monthly term.
Okay, so when it comes to HELOCs, you said a withdrawal. So, for an example, if I wanted to take $20,000 out, do I have to pay that whole $20 back immediately?
You don't. So you have a draw term. So whenever you apply for the home equity line of credit, you'll apply based off of kind of what your needs are, and you'll be able to select. Some lines of credit have draw terms of like 10 years, 5 years, 2 years.
Okay.
And so during that draw period, say like you said, if you took a $20,000 home equity line of credit, you can use, pay off, and redraw from that $20,000 as much
within that term.
Within that term.
Okay.
Once you get to the end of that term, like I said, say if it's 10 years, once you get to that, the end of that 10-year period, then you have to start paying back on whatever that balance is, and you can't like draw from it anymore.
Okay. So if I can put this in an example, because that's kind of how I work. Well, let's take the same $20,000. We have a 5-year term.
Right.
And I pay $10,000, another $20,000 back. But I use the whole 20 though.
Right, but you paid, so at the end of that 5 years, you have 10 that's actually left as your balance.
Yes.
Right, so now you're paying on that 10,000 that's left.
Because the 5 years is already up.
Correct. And you can't access that other
10.
20 or other 10.
Okay. So, that's still...
Yeah, so it's still not bad.
Yeah,
the thing that you want to make sure of, though, when you are in that is, in most cases, that, I don't want to say most cases, it depends on how the line of credit is structured. But what you run into is if you do have a huge balance, once you get to that repayment period, the payment can jump, right? Because it's different because before you were just kind of paying what you use.
Understand.
Right.
Now you have an amount you need to pay back. That makes
a
lot of sense. Okay, so that's more so with HELOCs. So with home equity loans, you said it's just a fixed amount.
It's a fixed amount. So think the easiest way to put it into an example is think cash out refinance. You know how like...
We just talked about refinances on the channel. We did.
Yep, you did. Shout out Stewart.
Yes,
yep.
Stewart.
Shout out Stewart. I see. So think cash out refinance, right? You know how you refinance, you take that lump sum of equity out, you use it for whatever you want to.
Yes.
You have a set term that you repay.
Yes.
Right? The home equity loan is similar, minus the refinance part.
Okay.
So say in the same instance, you want $20,000.
Yes.
I have a set thing I want to do. Say I'm consolidating debt. I have $20,000 that I need to consolidate. I want this lump sum of $20,000. It's like, okay, here's the $20,000 in equity. Here's a repayment term.
Okay.
Straightforward. There's no variable to it. No redrawing. You have your one lump sum. You use it, pay it back. That's it. So almost like think sometimes you'll hear a home equity loan called like a second mortgage.
Yes.
Same principle.
Yes.
Because that's essentially what it is. It's just a set fee, lump sum, and you take it.
Okay. Now, when you said variable, because I know this, but when it comes to variable, is that more so with the HELOC?
Correct.
Not variable into interest rates?
Correct.
Okay. So HELOC, home equity loan is fixed.
Fixed.
Okay.
Fixed. So home equity line of credit, kind of like a credit card, right? Like the interest rate is going to vary with what's going on with the market.
Okay.
Home equity loan, it's like a mortgage. It's fixed. This is your rate. Sometimes the rate may be a little bit higher because it's a fixed rate. So like that introductory rate on the home equity line of credit may be a little bit lower.
Okay.
But because it varies, you don't really know what you're getting into. Whereas that home equity loan is set.
You know exactly what the payments are.
Right. It's predictable. It's straightforward.
That sounds good. I'm a risk.
Yeah.
I'm not a risk taker, but meanwhile I'm in real estate, so I guess I am kind of.
Yeah, we take risk every day. Trust me.
Okay, we take risk every day. Okay, so I heard. Well, you hear all the time that whenever you're renovating a home, just take a HELOC. Should people use a HELOC if they want to renovate their home, or you think it's best to use a home equity loan?
So my advice is always it depends on the situation and the what was I gonna say? It depends on the situation and the amount.
Okay.
Okay. So if it's a situation where you're renovating, say you have a couple different projects, and it's variable, right? You don't know, like you might have to do some for like a kitchen, and then you may have a little bit to do for a bathroom, and like you're kind of paying as you go. Then a HELOC is going to be great because you can continue to draw against it, right?
Within that term.
Right. So like if you need $5,000 for this part of the project, you pay your $5,000 there, you pay that back, you're good. All right, now I need $3,000 for this. You do that, right? And then you do what you got to do for that term, pay it off, you're straight.
Right.
If it's a larger project, then, or it's a project like, hey, it's going to take $15,000 just for a number, and I know that's all I'm gonna need, and I want to just pay that $15,000 off.
Yes.
I want it to be predictable. Then a home equity loan
would be
better.
Okay.
Right.
So I guess whenever you're using a home equity loan versus a HELOC, if you already just know what the amount is. Right. So in the sense for renovations, you probably want to use a HELOC. Most
time renovation purposes.
Yes.
You want to use a HELOC. Also, like say if you are trying to like purchase another property, or say you're trying to purchase like a fix and flip or something like that, like an investment type property, then most times home equity line of credit is going to be better for you because you take it, you get your money out, use it for the project, pay it off, and now you have that line open to continue to do things that you want to do later on in terms of investments or renovations to the house or whatever the case is.
Okay.
So
to piggyback off what you're saying, if you wanted to use money in your home, you want to use your equity to purchase another home. Let's say we know what the closing amount will be. It'll be like $20,000 for closing right now.
Right.
Would you think a home equity loan would be best? Or probably still go the HELOC route just because it can just change when it comes to like the closing disclosures or closing amount?
Yeah, I mean, in that situation, like if you just purchasing the house and you know like, hey, this is what I have, I still probably would say go HELOC.
Okay.
Because once you get into the home, there might be other things that you want to do, right? 9 times out of 10, if you are leveraging that equity for this sum of money, you're probably going to end up having to leverage something else as you first get into it, right?
Like just what if you want to add a fence?
Right.
Okay.
Or you want to
update the kitchen
furniture
or
whatever, right?
Yes. Okay.
So it's like, as opposed to like with the HE loan, if you just took the 20 and now you got to use credit cards or something like that to do the rest of it, you're kind of hustling backwards in that sense.
I understand.
Right?
So it's kind of more strategic if you're going to purchase another home to use a HELOC.
Right.
Nice.
Right. And then what I have a couple clients or investors who have done it before where, they have that HELOC and that's what they use, right? So it's like, I'm buying this house in cash with the HELOC, this is what I'm
Excuse
financing.
Excuse
me. There's levels to it. But yeah. So I'm gonna buy it in cash with the HELOC.
Yes.
I'm going to do renovations. Pay for the contractors. All this stuff I'm doing through the HELOC. Because I bought the house in cash. Once the house is done, either they're gonna refinance it if it's something that they're planning on renting out. They're gonna do a delayed refinancing to get the cash back out.
Okay.
Or they're gonna sell it, take the proceeds, pay off the HELOC, have it open again.
And
you take your profit, do what you're doing with it, and then use the HELOC for the next project. So it's all about the strategy.
It's all about a strategy.
It's all about the strategy.
Ooh. So for people who, like myself, we bought our home back in 2020, and it was a different time. Such a good time.
Great time.
Great time. So a lot of us are more so sitting on like maybe $100,000 equity or more.
Right.
Can you take the whole? Is it $100,000? I'm not going to do it, but is it a certain percentage you have to be able to use for, you said HELOC?
Yes, for HELOC
versus
or for
HELOC.
both. Great question. So both of them are going to have loan to value ratio limits.
Okay.
So when we're talking about doing multiple liens, like when you buy the property originally, you have your loan to value ratio, FHA 3.5%, whatever the case is, right? So when we talk about multiple liens, you have your combined loan to value ratio, which basically is all the liens on the property can't be above X amount to the value. So depending on like your credit score and the amount you're taking, normally for both of these products, you have to leave anywhere from 80 to 90%, or excuse me, not leave. The combined loan to value ratio maximum is somewhere between 80 and 90%. Okay. So you got to leave 10 to 20% in
to the home.
Right.
That's not bad.
Both loans have to be
within that. Right, well, 80% if we want to put a number on it.
Right. So at the 100,000 that you just mentioned.
Yep.
Like say you got 80,000 free and clear, right? Like. 100,000 free and clear. Like, say you don't have a mortgage, just for ease of.
Oh, okay.
Just for the ease of the conversation, right? So, like, if you wanted to take a home equity line of credit, you could take. Let's just meet in the middle and say you could take 85,000 because you have to leave 15 in.
Okay.
Right. So, same principle if you have a mortgage. If you got that equity of 100, you just have to make sure you leave whatever that
specific percent is. Okay, and they can find that out whenever they apply.
Right. Okay. When they apply. So like with us at CMG Home Loans, we have a HELOC that's like completely online.
Okay.
And so when you go to apply for it, it'll start with a soft credit pool and it'll tell you like how much you can get, what the payment terms will be and everything.
Okay.
So you can see it and review it. And then that's when like once the credit pool is done and they see, what the score is and what you're available to take, that's when it'll tell you like, all right, so this is going to be your maximum based on your loan to value ratio.
So that is a good question. I'm glad that you brought that up. Is there certain terms that you have to have with CMG Home Loans if you want to pull out like a HELOC or a HELOC?
It is. So that's the other part of it. Like you still want to make sure that like your profile is good because we're still going to use, and it's not only with CMG, it's pretty much with any home equity line of credit or home equity loan product. We're still going to base the approval off of credit score and debt to income ratio. So for most products, you still want to make sure you have at least a 640.
Okay.
Credit score.
640 sounds good.
And the debt to income ratio still usually is like 50%.
50%.
And that's including the repayment of the
the HELOC or the
right because that's always going to end up being counted in, so they kind of factor that into into your debt.
So when we talk about DTI or debt to income ratio, if someone wanted to know, how do I determine my specific debt to income ratio? Do you know how to? I know you do, but can you explain how to calculate debt to income ratio?
For sure. So the easiest way to calculate your debt to income ratio is think about all of your obligated expenses.
Okay.
Right. So when we say obligated, like your car payment, any mortgage payment that you may have, student loans, especially now with everything going on, you want to make sure you start counting your student loans back into.
Really?
Yeah. So just in normal situation, right? Like even without like the repayment starting and everything, it's always been black and white in terms of how student loans are factored in.
Okay.
It's either you're on an income-driven repayment plan and the lender's taking whatever that number is, or it's a standard percentage. If it's like Fannie Mae, a conventional loan, we taking 1%. If it's FHA, it's 0.5%. Like all the things where you had forbearance and I'm still in school, that doesn't matter for a mortgage. It's either one or the other.
Okay.
But now, especially because these repayments have started back,
yes,
it's not going to be zeros on the credit report anymore, right? They're going to have whatever that payment is. So you definitely want to make sure while you're looking at your debt to income ratio, you're aware of whatever your student loan repayment is or supposed to be, and like get on top of that if it's something that you're trying to do in terms of investing in real estate.
Because I know we got not we, but I know it's like a lot of people that have thousands of dollars into student loans. And I know that is something that people are concerned with.
Right.
So I guess should they more so just call someone to see?
I would definitely, I always recommend for my home buyers, whether it be first-time home buyers, move-up buyers, whatever the case is, right? If they have student loans, they're not on an income-driven repayment plan, I always recommend for them to call the servicer, see what kind of payment plan they can get on, because 9 times out of 10, whatever payment plan they can get on is probably going to be better than us having to count that generic amount.
Okay, good.
If that makes sense.
It does make sense.
So definitely want to count that into the debt to income ratio. Like I said, any obligated debts. Credit cards, we're going to look at the minimum payment. So whatever the minimum payment is. And then what you're going to do once you get that number, you're basically going to divide that into your income. If you're W-2, we're going to look at whatever your salary-based income is. We're not going to look at after taxes and all that. We're going to look at your right. We're going to look at your gross income.
Yes.
And you want to divide the obligations by the income
coming in,
and that's going to be your ratio.
Okay.
9 times out of 10, you want it to be, I say conservative, if you want to try to keep it under like 43.
Okay.
You know what I mean? Like we have programs that can go higher, right? But when you're looking at it and you're just trying to look at like affordability, that's generally like a good rule of thumb.
It's like a 43% DTI.
Because that gives you variance, right? Because you're not really going to know what your property taxes are going to be if you're getting a townhome or condo. You got HOA. You got you got little other things that are going to go into it.
Yes.
So that 43% kind of gives you a little leeway on the backside.
I done moved into
right. We're gonna switch the whole vibe of the jump.
I just know it's something that is people definitely need to know. Right. DTI is so important, especially in real estate. Right.
And all these things merge together because, like I said, it's a strategy, right? So,
yes.
When when we're looking at purchasing, in the beginning, not like plugging anything like that, but these are strategies that we talk about when. I'm talking with my clients and we're looking at the home, we're talking about like the wealth side of it on the back side in the beginning. So even though it's kind of a different topic, it all goes into the same lane, right? Because this is one of the ways you leverage the wealth and the actual investment of the property is with home loans or home equity line of credit, whatever. This is like your bank and your ATM. So you want to make sure that you can still be able to access it. So it all kind of goes hand in hand together.
So when and that's why I guess I preach all the time, especially to first-time home buyers or people who are kind of on the fence about purchasing a home or not. Your first home, you can just use it for so many different purposes tied into the HELOC.
Yeah, absolutely.
In it, so it's just a good move.
It's more than just a roof over your head.
It's more than just a roof over your head. So, because I'm definitely going to use mine. Let's go ahead and go back to it with the conversation I had. So I have, I am married. Look at us. Oh, we both are.
Right. Oh yeah.
So we both are married, and let's say one person's home is in their name, and the other party, they can buy a home, and that their home is not reflected on their DTI. Can they still use the HELOCs?
As long as they're on the deed.
They have to be on the deed?
Product specific, right? Every product, some products are a little bit different.
Okay.
But generally speaking, if they have ownership interest in the home, they can technically leverage the equity because it's still their home. Right. They're just not on
the deed.
The mortgage.
Right. The mortgage, the promissory note.
Right.
Okay, so in North Carolina, you being married, you have ownership
Right.
interests.
Right.
So would they be able to use it, or do I need to be on the other deed whenever we're purchasing? I put my business out there.
Right, before thing.
Now it's just
pre-planning. That's a good question. Question. I would definitely have to take that one
Okay, good.
offline and make sure, because I don't want to give the world bad advice.
I understand, because that's something I need to do.
Right.
I need to know myself. Like, you know what? Because we're going to purchase a home very, very soon.
Okay.
And I know I have all this equity in my home, so why not be able to use it?
Right. Right.
Mm-hmm. Okay.
Yeah, we'll definitely find out now.
Okay. Well, this was very great.
Okay.
This was very great. Home equity loan versus HELOCs is an
Right.
easier way to say it, phrase, because I'm always mixing them up
Right.
when I speak out loud. So if other people have more questions for you specifically, is it a way they can reach you?
Yeah, absolutely. So if you do have any questions in regards to what we're talking about, or just anything mortgage related, whether you're looking to plan, whether you're looking to refinance, or whatever the case is, you can definitely reach me at on all my socials is J York for short.
Okay.
On Instagram, Facebook is J York. My cell phone number is 704-957-3961. And email is simply the letter J, YORK, at cmghomeloans.com.
Thank you. Thank you, Jay. This is Andrea Robson with Motor Home Realty. And if you have any questions about buying a home or selling a home in Charlotte, North Carolina, feel free to contact me. And I'll see you next time on the Property Playbook, CLT.